we've got an analysis report today on New Fortress Energy, or NFE. It's really digging into that recent 11% surge after they got their forbearance agreement extended, and it's asking the big question. Is this finally the bottom for the stock?
It is, and the subject matter is just inherently dramatic, right? A debt crisis, a last-minute reprieve. So let's jump straight in, because I think the biggest opportunity for this analysis report is about aligning its tone with just how severe the financial situation really is.
Okay, I see that. Looking at the submission, the initial approach seems to be about grabbing attention. You've got the title, NFE explodes, plus 11% green day. Is the bottom finally in? With a rocket emoji.
Exactly. It's very high energy, very sensational, and that's designed to pull people in, especially from, the retail side.
But then there's this conflict because that style clashes so sharply with the data you present later in the bear case.
It really does. I mean, the analysis report does an excellent job laying out the risk. You're talking about a debt load of somewhere between, $7.8 and $9.3 billion?
Right, against a market cap that's just tiny in comparison. Around $363 million. That kind of leverage is a massive red flag.
So here's the question then. If the data is that serious, isn't taking a risk with a sensational title worth it just to get eyes on the analysis in the first place? Don't you lose all visibility if you start with a, super sober academic tone?
That's a fair question, but I think the issue here isn't really about visibility. It's about credibility, especially with the kind of expert listener you're targeting.
Go on.
Well, when the first thing they see is NFE explodes, it sort of implies a sure thing, a definite turnaround.
But the expert who knows distressed assets immediately sees the $9 billion in liabilities and that very short-term forbearance. The weakness, I think, is that the sensational tone risks undermining the credibility of the fantastic risk analysis you provide later on.
So that gap between the initial hype and the grim reality of the numbers could be really jarring for an informed person.
It's extremely jarring. They might just dismiss the whole thing as, overly promotional, instead of seeing it for the critically balanced analysis it is. You've done the hard work of digging into the risk. You don't want to dilute that impact right at the start.
So the suggestion is to recalibrate. Change the title and the intro language to reflect the actual stakes.
Yes, it's not a celebration. It's a survival versus wipeout scenario. The tone needs to match that nuance, that gravity of the January 9th deadline.
So instead of celebratory, it should feel more like high-stakes suspense.
Exactly. The opening should feel like the start of a financial thriller, not a summary of a small daily gain. For instance, instead of focusing on the 11% pop as a reversal, focus on what it really is, the market reacting to the company buying a little more time.
Avoiding immediate default.
Right. As for concrete examples, you could try a title like NFE, Debt Delay Triggers Surge, Decoding the Short Leash to January 9th.
Or even something like New Fortress Energy, one forbearance extension away from crisis.
Perfect. That frames the whole conversation around breathing room, not a definitive bottom. And that shift instantly aligns your tone with the data, and frankly, it respects the intelligence of your analysis report.
That makes a lot of sense. It shifts the entire frame from a simple price move to the existential countdown clock the company's actually on.
And if that tone is consistent from the very beginning, the expert reader is going to trust your analysis immediately.
Okay, let's move on to the structure of the arguments. I want to look at how the bull and bear cases are presented.
Good place to go next.
The analysis report does a good job separating them. You have the bull case, which is all about that $3.2 billion Puerto Rico gas supply agreement. And then the bear case, which you've called the debt mountain.
The report rightly points out that the Puerto Rico deal proves the business model can work, but only if they can fix the debt.
Right, but building on that point, while all the pieces are there on the board, I feel like the analysis doesn't fully connect them. It doesn't really argue how that cash-flowing asset, the Puerto Rico contract, can realistically fix that colossal debt mountain.
I understand that, but isn't just having a signed cash-flowing contract like that enough? I mean, isn't that proof of concept exactly what creditors would need to see to even consider a deal?
It's necessary, for sure, but it's not sufficient. You have to remember the scale we're talking about here.
A $3.2 billion contract revenue over time, mind you, against $9 billion in liabilities that are due, now.
Exactly. So the weakness is that the report leaves the listener with these two giant, disconnected facts. You have the asset, and you have the debt. But there's no clear, quantified path showing how one solves the other.
So the bullish argument feels more based on hope than on actual math.
Precisely, and that's a problem, especially when analyst targets are suggesting the stock could go to 350 or higher. You can't justify that target without bridging this quantitative gap.
So if the forbearance is just time bought, the real question is, what can they do with that time?
And that's the suggestion. The analysis needs to explicitly link the cash flow from that Puerto Rico deal directly to the debt mountain. You need to frame that extension period as time bought specifically to use this asset as leverage in negotiations.
Show how it becomes their primary bargaining chip.
Yes, show the mechanics. How does this asset actually relieve the pressure? Is it about servicing the interest, or is it big enough to act as collateral for a major restructuring?
It's probably both, and the analysis should really explore that. For a concrete example, you could add a sentence or two hypothesizing about that leverage. Calculate how the expected cash flow from the deal impacts their ability to just service the interest on the minimum $7.8 billion in debt.
If the cash flow covers the debt service, that alone makes the survival argument much, much stronger.
Immensely stronger. And then you can take it a step further. You could discuss what it means for the shareholder. Is that asset enough to avoid the worst-case scenario, which is a total wipeout?
Or does it just get them a deal that involves, say, massive dilution from issuing new shares?
A key distinction. A wipeout is a total loss. Dilution means the company lives on, and my stake is smaller, but it's not zero. That's a much better outcome.
So quantifying whether that $3.2 billion asset is big enough to push creditors toward dilution instead of liquidation, that's the quantitative bridge the analysis is missing.
That's it exactly. If you can show how that cash flow structurally changes the risk profile against the debt, the entire analysis becomes exponentially more robust.
Okay, let's pivot to the technicals. The analysis provides very clear levels here. Support is pegged at 116 to 120, which is called the floor before a retest of the all-time low. And then resistance is at 136 to 140.
Right. The ceiling that, if it breaks, could lead to a run-up toward 150, 160. The report also notes the high volume, about 16 million shares, which confirms there's real interest here.
The levels are crisp, they're easy to follow. I just wonder, though, if they could be tied more directly to the fundamental driver of everything, that short leash of the January 9th deadline.
So you're saying the technicals are solid, but in a special situation like this, they need to be telling a story about the debt talks.
Exactly. The chart is basically the market's nervous system, right? It's reacting to whispers from behind closed doors. If the stock is making a big move at one of those key levels, it probably means the smart money is making a bet.
I agree. So the weakness is that the technical analysis, as precise as it is, feels a little bit isolated from that crisis timeline. The high volume shows interest, yes, but the report doesn't really define what specific action on the chart would be the signal for, say, confidence in a deal versus imminent failure.
The expert listener needs actionable triggers that merge the chart with the crisis.
Yes. We need to turn those price levels from just static lines into dynamic signals tied directly to that Jan 9 deadline.
So the 116 and 140 levels should be framed as a live panic button and a confidence indicator.
That's a great way to put it. So the suggestion is to create explicit if-then scenarios. Link the technicals directly to the probability of success or failure in the restructuring.
The technical should be presented as a real-time stress test.
They should tell the reader, if you see this price action before the deadline, here is what the market is likely pricing in about the negotiations.
Okay, can you walk me through an example of how you'd frame that using those specific levels?
Absolutely. For a concrete example, let's define what a high-volume move would imply. You could state that a high-volume break and a sustained close above the 140 resistance before January 9th suggests the market is anticipating a favorable, maybe even non-dilutive, restructuring deal.
Implying that institutional money is betting the Puerto Rico asset is enough leverage.
Precisely. And then you do the same for the downside. What does failure look like on the chart?
Okay, so conversely.
Conversely, a high-volume clean break below that 116 support level would confirm the threat of Chapter 11 is right back on the table.
And why?
Because that's the point where anyone holding out for a better deal might panic, or where short sellers, knowing the company is on the ropes, would feel emboldened to press their bets. That kind of technical breakdown would justify shorts re-entering, and it could signal a swift return to the all-time lows.
I see the utility in that. By explicitly linking the technicals to the crisis timeline, you're not just giving a price summary, you're giving an active monitoring guide for a distressed asset.
And that is the real power of integrating fundamentals with the chart. You're telling your expert audience exactly where to look for signs of confidence or alarm as the clock ticks down.
This has been really productive.